Hi, my name is Selena Liu and I'll be running through the simulator today. So we'll be going through lesson Acuna 2221. So to start off, we trade the options with a red or blue background by clicking on these and then clicking on the reset button to continue to maintain our competitiveness in the market. We'll then go on to purchase some underlying futures on the top left hand corner to ensure delta falls within the range of the absolute value of 2 in order to retain our delta position. We also purchase some out of the money call options. So you'll see at that instance that call option had a delta of 0.02 and then 0.05. Also note that we click on the reset quote button when the values are red to ensure competitiveness. And if you look on the right hand side, you'll note that the volatility curve is gradually increasing as we continue to purchase those call options.
My name is Caesar and I'll be explaining the general strategy being used for this simulation. To begin, we traded an out-of-the-money call option with edge and focused on maintaining a loose level of balance between call and put options to keep the Greeks reasonably in check. We continue looking for opportunities to collect more edge, with a low priority on managing most Greeks except Delta. We have to keep a check on Delta, as other competitors in the market are forcing our delta to become too large and pass the delta breach region. We also ensure we purchase the options with edge quickly, or else the competitors could potentially take these opportunities. We utilize some of the instruments as well, but note the 16,000 unit jump on cash gamma especially. The instruments have heavy effects on the Greeks, so we take both positions at different times to reduce the huge Greeks effects these instruments have on our portfolio.
Hello, my name is Martin Doe and I will be explaining the Greeks values and what they mean in the simulation. As you can see in the bottom left, the delta value is switching back from the negative 0.3 to negative 0.4 value. This means that for every dollar increase in the underlying stocks, there will be a decrease of 0.3 to 0.4 dollars in the portfolio. We can also see that the Vega is at the 1879 over 1867 value. This means that for every % increase in volatility, it will correlate to a 1879 or $1,867 increase in the portfolio value. For the theta value, it is around the negative 420 mark. The value of theta is the value of the portfolio proportionate to time, so we can expect a decrease in the value of around 420 in our portfolio per day. We are holding options or holding a long position, meaning that the closer our options get to expiry, the less value they hold, hence the negative theta. Our 1% dollar gamma is around the 14,000 area, which means that every dollar increase will correlate to a 14,000 increase in delta value. Thank you.
Hi, I'm Alex Grady. So in terms of the strategy that we've chosen, we'll continue to increase the volatility of 0.05 out of the money calls by pressing the green buttons, as well as trading options that flashes blue and red. In this way, we've managed to minimize the delta breaches to a very small amount by buying and selling futures consistently throughout the simulation. I'd like to draw your attention to the volatility curve. As you can see, the underlying price keeps moving upwards at a steady rate and is now reaching a value of 370 from an initial value of 369. While keeping the Greeks under control, we've decided to not make too many trades, avoiding wholesale trading and keeping trading combinations to a minimum to reduce the overall risk of the portfolio. In addition, by persistently pressing reset quote, we are securing a more competitive position within the market. Upon viewing the matrix of Greeks, delta has become more stable, theta has become more negative, and both gamma and vega have increased and become positive. Overall, we've managed to secure the values and keep the Greeks at a reasonable level. I'll now hand over to Shane, who will conclude the presentation.
So now we're trying to make as many trades as possible at this point, as we know time is running fast. It will probably come to an end soon. In response to the large strangle coming into the combo screen, we lowered our volatility accordingly. Even though we breached the delta limit twice, we successfully navigated our way out of it by buying futures. As you can see in our trade risk matrix, for a 0% price movement, we have a vega of negative 1,368, a theta of 142, a gamma of negative 9,444, and a delta of 2. For an increase of 30% in our price movement, we have a vega of 13,963, a theta of negative 2,271, a gamma of 56,668, and a delta of 107. On the other hand, for a decrease of 30% in price movement, we have a vega of 49, theta of negative 10, gamma of 285, and delta of 20. We end up with a profit and loss of $6,673 by carefully controlling our cash gamma, and our other Greeks are also under control. So this reaches the end of our project. We hope you enjoyed it. We really appreciate your time. Thanks for watching.